basically, our capital allocation is focused on world-class entities with growth and strong but undervalued fundamentals as main criteria. And when opportunities arise, we also make real estate deals, as we did last week.
Okay, so I know you're here to talk about value investing. Just one question about real estate. You invested both in Paris and in New York in the past 10 years. How do you see those markets today?
Well, Manhattan is a very specific market. It's a bubble that never explodes. So what I do is just wait for the next major housing downturn.
As you did during the subprime crisis.
Pretty much, yes, because the prices are highly based on a pressure that is often irrational.
But so are you implying that the prices are artificial in New York City?
Well, the prices are very much market-based compared to the European market, which is somewhat smoother. Meantime, loan conditions are easier in Europe. So our trick is to borrow money in Europe, taking advantage of the low interest rates and sometimes a strong euro, and to invest in the US. So we just get banks to talk to each other, which is not an easy feat.
I imagine. But talking about the euro, do you think it'll continue to rise versus the dollar?
Well, there are surely many people who can tell smart things about it. I can't. I don't predict the future. I never did. I just investigate investment cases, trying to figure out their current worth, focusing on their track record. What I do know for sure is that Europe and the United States are two very stable economies, and I don't see why they aren't going to remain that way.
So you're optimistic then?
Oh yes, yes. On the long-term period, yes.
Okay, let's go back to value investing. You're a big fan of Warren Buffett. You wrote about him. Why do you think value investment is not more popular than it is today?
Well, that's a very good question. Maybe it's because it's not glamorous enough, or, well, in fact, I think it's not glamorous at all. I mean, it requires a long-term approach, a thorough investigation, humility, patience, and I'm not sure the industry is structured in a way that fosters such investment strategies and rewards long-term returns.
Okay, but let's take the Main Street individual. They've heard a bit about it. Now, how can they find bargains around?
Well, the secret is well known. Distinguish value from price. I mean, decipher the intrinsic value of a company, just like you were about to buy it entirely, and then wait for the stock price to fall far below this value.
Okay, between 2008 and 2010, you made a 100% return on your investment with Goldman Sachs. Tell me about this move. How did you find the golden nugget?
Well, first of all, thank you, but first of all, everyone who invested in 2008 and withdrew in 2010 realized the significant profit. That's the first point. Now, about the choice of the company or of the stock, Goldman Sachs was, and in my opinion still remains, one of the best investment banks in the world. They had half a Paulson plan in assets in 2008. Right. They've consistently shown a strong shareholder return policy. Lehman Brothers had collapsed, allowing GS even more opportunity to grow profit. So timing was perfect. Now, regarding valuation, the core of the bargains you pointed out, when the market sets the price of Goldman Sachs stock in November 2008 at $56 per share, whereas the same Goldman Sachs owns $110 cash per share net of debt, you don't have to be a genius to concur that the stock price doesn't reflect the reality of the business, and that this heavy undervaluation is due to, I don't know, deleverage, market seizing up, lack of credit, or uncontrollable fear of the market itself, but has nothing to do with the fundamentals of the company.
Okay, when did you decide to trigger this investment? And generally speaking, when do you trigger an investment?
As soon as what we call the safety margin between value and price again reaches 40 or 45%. And ironically, this usually happens on a day when French newspapers cover story is about the end of capitalism. Yes. So, but really the main idea is really that the time spent and thoroughness of the valuation, which both allows us to hold very strong convictions and wait several years if necessary for the stock price to reach our fair value estimate.
Okay, have you ever been tempted by another investment philosophy?
Well, I read George Soros's book, The Alchemy of Finance, right. Which is an hymn to microanalysis, and then the guy, of course, is a success story. But the problem is that it's like Chinese to me. I mean, I'm unable to apply any of his precepts. And on the contrary, when I stumbled upon Security Analysis, written by Ben Graham in 1934, it became obvious to me. So I just trickled down the list of his followers. David Todd, Philip Fisher, Michael Price, Charles DeVaux, Frenchman, Warren Buffett, of course, all great masters.
What is the best investment book you've ever read?
I would like to say something about your question, if you don't mind, about the investment philosophy. I really think that the choice of an investment philosophy is a question of personal character.
What do you mean exactly?
I mean, I still own my early years startup company. As a human being, I feel, I'm a long-term guy, and long-term approach and safety fits me very much, and that's why I feel very comfortable with this way of investing.
Even if it's not considered glamorous?
Well, some people may consider compound interest as glamorous.
Are you one of them?
Well, sure. That's basically how we think. What will be the yield of return of our next investment, and our company status, our private company status with nothing to sell or to report or to justify to anyone, allows us to study every investment peacefully.
Well, Denis, there's only one place in the world where compound interest can be considered glamorous, and that's here in Paris. Again, thank you very much. And just for the record, how would you say compound interest may be considered glamorous in French?
On peut voir du glamour dans les intérêts composés.
Well, it's definitely more glamorous in French than in English. Thank you again, Denis.